Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 7.1 of Unit 7, Fundamental Analysis. In this lesson, we're going to cover the basics of fundamental analysis and how it applies to Forex trading. By the end of this video, you will understand why currencies move and how to use fundamental analysis to inform your trading decisions. Let's get into it. Fundamental analysis is the study of economic data to understand why currencies move. It's like trying to figure out why a certain store is popular. You look at the quality of the products, the customer service, and the overall shopping experience. In Forex trading, we look at economic data to understand why a currency is strong or weak. The core principle of fundamental analysis is that a healthy economy attracts investment, which increases demand for that currency. Think of it like a popular restaurant. If it's doing well, more people want to invest in it, which increases its value. The key chain of events in fundamental analysis is that a strong economy leads to the central bank raising interest rates, which attracts foreign investors to buy the currency, causing it to strengthen. This is a crucial concept to understand in Forex trading. Fundamental analysis covers a wide range of factors, including economic data releases, central bank decisions, and news events. These are all important to consider when trying to understand why a currency is moving. Fundamental analysis tells you why a currency is moving, while technical analysis tells you where it's likely to move. Think of it like a map. Fundamental analysis gives you the underlying reasons for the journey, while technical analysis gives you the route to take. Market expectation matters more than the actual number. If the market expects good news, but the actual number is only okay, the currency might actually fall. This is a critical concept to understand in fundamental analysis. For example, if good news is already priced in, the release of that news may actually cause the currency to fall. This is because the market has already accounted for the good news, so there's no additional surprise to drive the currency up. The most important fundamentals to consider are interest rates, inflation, employment, and GDP. These are the key indicators of a country's economic health and can have a significant impact on currency movement. In summary, fundamental analysis is the study of economic data to understand why currencies move. It's a complex topic, but by focusing on the core principles and key fundamentals, you can gain a deeper understanding of the markets and make more informed trading decisions. Remember, fundamental analysis is a powerful tool for understanding the markets. By incorporating it into your trading strategy, you can gain a competitive edge and make more informed decisions. That is everything for Lesson 7.1. What is fundamental analysis? If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.